Imagine being one of the most explosive growth darlings of the last decade, posting absolute record-breaking revenues and watching your stocks still completely crash by 60%. How does that even happen? How does a company command a massive growing share of the multi-billion-dollar energy drink market, report the highest top-line numbers in its entire history, and still have Wall Street just sprinting for the exits? Well, today we're answering exactly that. We're looking under the hood to figure out if this is a fundamentally broken business or if the market is entirely mispricing a dominant platform that's just undergoing a painful but temporary structural transition. Let's get right into it. So here is the massive valuation disconnect staring investors right in the face. Following a huge Q2 earnings shock on August 6, 2026, Celsius stock just plummeted. It broke its 52-week low to hit just $24.44. I mean, that is a staggering destruction of shareholder value for a company that generated over $2.5 billion in revenue in 2025. It's the exact kind of drop that forces you to ask, is the hypergrowth story officially dead? To figure out what actually went wrong, we first have to understand the economic engine of what this company has really become. See, Celsius is no longer just a single brand story. In fiscal year 2025, they went through a massive structural transformation. Through two back-to-back acquisitions, they bought the female-focused wellness brand Alani for $1.65 billion, and then followed that up by acquiring the traditional male-focused Rockstar Energy. And this brilliantly shows off their new strategy. They've built a three-brand platform targeting distinct consumer demographics. You've got fitness enthusiasts, Gen Z wellness, and classic high-caffeine gamers. Collectively, this consolidated platform now commands 20.1% of the U.S. ready-to-drink energy market. But great brands still need a way to actually reach the consumer, and that is exactly where their competitive moat comes in. Celsius operates under what's called a category captaincy with PepsiCo. Basically, this means Celsius acts as the primary strategic energy lead for PepsiCo's entire direct store delivery system across the US and Canada. This creates incredible structural switching costs for retailers. Instead of negotiating with dozens of independent brands, store managers literally just deal with PepsiCo to stock Celsius, Alani, and Rockstar, securing that prime cold vault cooler space across North America. And the total addressable market they're attacking? It's massive. The global energy drink market is projected to reach over $157 billion by 2034. Plus, Celsius is perfectly positioned to capture a highly profitable structural tailwind, the consumer shift toward permissible wellness and functional nutrition. People are actively moving away from legacy, high-sugar sodas and demanding clean-label, functional beverages. Now, what's really interesting here is the intellectual property defending their position. You've got private labels like Costco's Kirkland always trying to undercut on price, but Celsius has a clinically proven thermogenic formula. Their core drink literally accelerates a consumer's resting metabolism by an average of 12% and burns 100 to 140 calories per serving. That kind of scientific validation just cannot be legally replicated by generic price-cutting competitors. So you look at this and think, the market is huge, the moat is deep, and the products are scientifically backed. Which brings us to the obvious question, what went so spectacularly wrong? Let's pivot to this central conflict. On August 6, 2026, Celsius reported their financial results for the second quarter ending June 30th, 2026. And underneath the headline numbers, Wall Street found several massive friction points that absolutely terrified them. First up was the core revenue miss. Celsius generated $817.9 million in the quarter. Now, on the surface, sure, that's a 10.6% increase year over year, but it vastly underperformed Wall Street consensus expectations, which were sitting way up at $886 million. In the hypergrowth world, a $68 million top-line miss is blood in the water. But honestly, the total revenue number wasn't even the scariest part. When you break down that $817.9 million by brand, a pretty shocking narrative emerges. The namesake, core Celsius brand, the actual engine that built this company, declined by 11.7% to $387 million. The only reason the company posted overall revenue growth was because of the rapid scaling of the recently acquired Alani, which brought in $364.4 million. Rockstar added a modest $66.5 million. The market woke up and realized the core brand was suddenly shrinking. And by the way, if you like deep evidence-based stock breakdowns like this, make sure you're subscribed. So why on earth did the core brand shrink? Management gave a remarkably candid answer on the earnings call. CEO John Fieldly admitted, "We went too deep on the Celsius rationalization." Basically, management had aggressively tried to optimize their SKU count, eliminating slow-selling flavors to improve efficiency. But they cut way too deep. It resulted in a 7% contraction in total distribution points.
They literally left empty retail shelf spaces, and as CFO Jared Linghans pointed out, reclaiming permanent cooler space requires massive labor and capital from retail partners. Once you lose that precious shelf space, getting it back is a very painful, very slow build.
And to make matters worse, their earnings absolutely collapsed. GAAP net income fell 45% year over year. Why? Because of this massive number right here, an $80.9 million distributor termination fee. To get their new acquisition Alani new fully integrated into the massive PepsiCo direct store delivery network, they had to literally buy their way out of old distribution contracts. It was a brutal one-time hit that crushed their bottom line and contributed to their gross profit margins contracting all the way down to 48.1%. So with all that, is the business fundamentally broken? Let's bring up our quality scorecard and assess the underlying platform beyond just one bad quarter. The scorecard tells a story of a company going through a really tough structural transition. Their market position and financial health are actually incredibly robust, driven by a strong cash pile and very minimal debt. But their business viability score takes a severe hit. Why? Because of heavy concentration risk. PepsiCo alone accounted for over 43% of their fiscal 2025 revenue. If that relationship ever frays, the distribution moat evaporates entirely, which drags their overall blended score down to a 7.1. All of the research behind this explainer was created using Flash by StockSentinel.ai. You can generate deep research reports like this one for any public company in the world, completely free at flash.stocksentinel.ai. The core company research is free. If you want an ongoing investing edge, Flash has a premium feature called Best Ideas Now. Every week, it surfaces the highest conviction ideas across 3 investor styles: long-term compounders, quality businesses built to compound for years; hidden gems, under-the-radar names with asymmetric upside; and dividend hunters, durable income with the fundamentals to back it up. Premium also includes Portfolio Watch, which monitors your portfolio and flags important changes, and Insider IQ, which tracks meaningful insider buying activity worldwide. You'll see a QR code in the bottom right of the screen. Scan it to download the Flash app and try it yourself, or access Flash on the web at flash.stocksentinel.ai. Pricing is going up over time, but once you lock in your subscription, your price never increases.
Okay, let's move into our 5-year scenario analysis. But before we start, I need to be perfectly clear. This is a hypothetical framework for thinking about possible outcomes. It is not a prediction, and it is not financial advice. The stock could go much higher or much lower than any of these scenarios. But we do need a mathematical way to anchor this massive valuation disconnect we're seeing. So we are going to look at 3 cases: high, base, and low, projecting out to fiscal year 2031. We're anchoring all of this to the current post-earnings share price of $24.44, and we are also factoring in their $1.0 billion share repurchase program, as well as the potential conversion of PepsiCo's preferred equity. And remember, if you want to access the full model with all the detailed assumptions for each scenario, you can check out the free research report at flash.stocksentinel.ai. Let's start with the crucial one, our base case, which we're giving a 55% probability. This assumes management successfully finalizes their really messy SKU optimization by late 2026. Under this scenario, the core Celsius brand returns to a modest 5% organic domestic growth in 2027. International expansion gains a little bit of traction, and supply chain synergies help net margins recover nicely to 11.5%. If they hit those operational metrics, they generate roughly $5.8 billion in revenue by 2031. Slap a mature beverage PE multiple of 25 on that, and it implies a future share price of $63.25. Now, let's see how things build in the high case, which gets a 25% probability. This requires rapid, flawless operational execution. The core brand accelerates quickly as they successfully win back that cold vault space. Alani Nu continues its explosive growth trajectory, and international sales actually hit 15% of total revenue. This assumes an 18% revenue CAGR out to 2031, and net margins expanding to 14.5% due to incredible scale. In this wildly successful scenario, they earn a premium 35x multiple, bringing the target share price up to $153.65. But we absolutely have to look at the low case with a 20% probability. Here, the core brand just fails to regain its lost shelf space. They're forced into persistent promotional discounting just to fight off private labels, which crushes gross margins down to 45%. Furthermore, regulatory pressures severely limit their ability to market their products. Overall growth stalls to just a 6% CAGR. Earnings compress, stock buybacks completely halt, and sitting at a 15x multiple, the stock drags all the way down to $15.75. Now, when we probability weight these 3 scenarios, 25% for the high, 55% for the base, and 20% for the low, we get an expected future value of $76.35.
Compared to the current $24.44 share price, this math implies a highly asymmetric risk-reward profile for patient investors. Essentially, the upside of stabilizing this multi-brand platform mathematically outweighs the downside risk, at least on paper. But what exactly is that downside risk? What are we really worried about? Let's move to the hidden risks and look at exactly what could fundamentally break this long-term thesis. We like to look at risk through a progression framework. Step 1 is operational friction. Simply fighting for shelf space requires high promotional spend. If PepsiCo stalls on inventory rebalancing, growth stays stuck in the single digits. Step 2 involves the early warning signs investors absolutely must watch for. If gross profit margins drop below 45%, or if the core brand market share slips below 9%, the turnaround is actively failing. But the final, most terrifying stage is thesis destruction. And for Celsius, that destruction wouldn't just come from bad margins. It would come from the government. This right here is the most severe tail risk hanging over the entire company. On June 4, 2026, Texas Attorney General Ken Paxton launched a formal investigation into Celsius and its subsidiary Alani for potential violations regarding youth-oriented branding of highly caffeinated drinks. This wasn't out of nowhere. It was triggered by a wrongful death lawsuit involving a 17-year-old cheerleader who tragically suffered a fatal cardiac event in October 2025, which the medical examiner linked directly to excessive caffeine from Alani. If this litigation sparks multi-state marketing bans, mandatory age limits, or severe warning labels, it would fundamentally destroy the company's core wellness brand equity. So let's bring all of this together. Here are the 3 main things you should take away from this explainer. First, the terrifying Q2 margin and earnings collapse was largely driven by an $80.9 million one-time transition fee to get Alani onto the PepsiCo network. Yes, it looks awful on paper, but it is transitional. Second, the self-inflicted SKU optimization hurt them deeply. Reclaiming that permanent cold vault shelf space for the core brand is now their single most urgent operational priority. And third, at roughly $24 a share, the valuation presents massive asymmetric upside, but it is heavily weighed against some very severe regulatory and legal tail risks. Which leaves us with our final thought. That 60% crash, it wasn't irrational. Wall Street hates uncertainty, and empty retail shelves combined with massive transition fees provide plenty of it. But beneath all that noise, Celsius remains a highly profitable, asset-light platform that commands 1/5 of a growing market. If they can survive the regulatory scrutiny and win back their shelf space, the market has deeply mispriced their future. If you want the full research, including the deeper framework behind this explainer, you can get it free at flash.stocksentinel.ai. Until next time, do your own research, and I'll see you in the next one.
Check out Flash at flash.stocksentinel.ai to access free research and videos like this one for any company in the world.